It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Stocks in Asia struggle for direction following a sluggish U.S. session, with investors split on whether the market can sustain this month's rally. The U.S. revokes licenses allowing Huawei to buy semiconductors from Qualcomm and Intel, further tightening the screws on the Chinese tech giant. And the fear gauge for Indian stocks jumped to its highest this year on signs Prime Minister Modi's ruling party may win fewer seats than expected in national elections. Well, let's get you to markets and how markets are faring here in Asia. And Avril Hong is on top of that. Avril, it seems that markets looking for catalysts to go higher and finding none.
Looking for something that will push that momentum, as you well know, Has. In the month of May, Asia stocks have done a pretty decent job at recouping that April rout. This is thanks to Fed optimism as well as pretty solid earnings out of the US. But as we saw overnight, that US stock string of gains has stalled, that is sputtering. So Asia stocks quite a struggle for direction, and the declines are being led by Japan today. Where we are seeing strength is in the US dollar, and that's putting pressure on Asia currencies. But flip the board, I wanted to show you some of the stocks that we've been keeping an eye on, including Hyundai Marine. This is a ship repair firm in South Korea, and it made its trading debut today, and quite a splash, 45% gain at one point. And this really helps to cement South Korea's position, I think, as one of Asia's busiest venues for fundraising, especially after a slew of reforms to unlock shareholder value. The other stock we've been watching, Nintendo, we got earnings and a weak outlook, slumping by the most since February. But in general, tech shares in Asia have been under pressure today as their US counterparts struggled for gains overnight. Let's flip the board, because as we search for signs of recovery in the Asia Pacific, we have been seeing the MSCI China in overbought levels, and where it goes from here will depend a lot on the Chinese answer to the Mag 7's Tech 8s. We've seen how they, similarly to the Mag 7s, have an outsized impact on these Chinese benchmarks, but at a discount. So this will be key to watch going into next week, as well as we keep an eye on some of their earnings. Tencent, Alibaba, Baidu, and JD.com, Has.
That's right. And Morgan Stanley says if you're chasing that tech rally in China, follow the themes, not the indexes. Avril Hong, thank you so much for that. Now, the U.S. government is further tightening its export restrictions on Chinese telecom giant Huawei. For more, we bring in our Chief North Asia correspondent, Stephen Angle. Steve, what new action from D.C. are we talking about here?
Yeah, earlier you said tightening of the screws. That's a good way of putting it, because these Biden administration export controls really been targeting a number of companies, but more precisely, I guess you could say, Huawei. And again, we're hearing from sources that the Biden administration has essentially revoked licenses allowing Huawei to buy semiconductors from Qualcomm and Intel, affecting U.S. sales of chips used in Huawei phones and laptops. Now, U.S. Commerce Department has confirmed the withdrawal of certain licenses for exports to Huawei, but declined to offer specifics. But what we do know is one congressman, that's Michael McCall. He's a Republican from Texas. He says they're essentially going to block all semiconductor sales to Huawei, because in his words, he said those companies, Qualcomm and Intel, have gotten a little too close to China. That might not be the total fact. Qualcomm has actually said their shipments to China and Huawei have dwindled to a trickle, basically, and in the future they see it even getting less. But nevertheless, the U.S. really focusing on Huawei not getting advanced chips. Right now, Qualcomm has been able to sell chips that go into 4G phones, but not more advanced like 5G. So you're going to see, according to these sources as well, potentially the U.S. Biden administration also going after perhaps 6 Chinese companies, with sanctions for providing chips that and chip-making equipment potentially through a third party into Huawei. So, yes, it's tightening of the screws on Huawei by the Biden administration.
Steve, you got to wonder if Huawei will push back. Chances are it will. What form might that take?
Well, again, this has been something that Huawei has been faced through the Trump administration and now the Biden administration. So there have been ways, and we saw this, and we have the video. I believe it was last year when the Bloomberg investigators untightened the screws of one of those Huawei phones and essentially found a 7-nanometer semiconductor in there made by Semiconductor Manufacturing International, or SMIC. And the allegation there was that perhaps those chips were made with U.S. equipment, which would essentially, the way the export controls and sanctions have been written, would be in violation of that. So again, that's where it comes back to the potential sanctions against those 6 other Chinese companies. But again, Huawei obviously will be looking to the domestic market, will be looking to other markets, definitely not the U.S. market. But again, it's another hiccup, if not speed bump, for Huawei if it gets further sanctioned and the restricted access to those lesser advanced chips from Qualcomm and Intel.
TikTok also in focus today, Steve. Its Chinese parent ByteDance launching a formal legal challenge to the U.S. law, forcing it to divest or face a ban. What do we know about this lawsuit? We know, though, is that it's going to take a long time.
Yeah, that's right. I mean, look, it's essentially TikTok's not going to roll over and just willingly divest. I'm talking about the parent company, ByteDance, divest its stake in TikTok. They are going to fight this through the legal courts. Again, that Biden administration, Biden signed the law that had bipartisan support in Congress that essentially forces TikTok to divest its Chinese ownership stake or face a ban. And that ban would come into place if it had not divested that stake on January 19th, 2025. So there's still more than 8 months to go. And essentially, in this legal filing, TikTok is essentially saying, we're not going to comply, we're not going to sell, and they're going to take legal action, essentially declaring that the ban by Biden is unconstitutional. It violates First Amendment rights of free speech and represents an illegal punishment without due process. It singles out a single company. It said that, and there was not any evidence that was provided by the Biden administration essentially outlining why TikTok is a national security threat. And that's a key point, because if this does go through the courts, which could lead to the Supreme Court, that's the onus perhaps will be on the Biden administration to provide that evidence of how TikTok is potentially a national security threat to the United States.
Steve, great insights. Our Chief North Asia correspondent Stephen Angle there. Now, speaking of TikTok, former U.S. Treasury Secretary Steven Mnuchin says he's still interested in buying its U.S. operations from ByteDance. He spoke with us at the Milken Institute Global Conference in Beverly Hills.
Still very interested in buying it, and to the extent they want to sell it or spin it off, we very much want to pursue that. I support that Congress passed the bill and it's now been signed into law. I will say this has had just incredible, overwhelming support with Republicans and Democrats. This may be the only thing that everybody agrees on. The fact that it's on 160 million phones, I do think it's a security issue.
Does the deal still work if the algorithm doesn't come with TikTok?
Well, the Chinese government has been very clear that they won't give an export license on the algorithm, and I understand that. We have sensitive technology that we don't want to transfer to them, and they don't want to transfer this to the U.S. I've actually spoken to a lot of tech companies on working about rebuilding this. I do believe the algorithms could be rebuilt. So my plan, if we were to purchase it, would be to rebuild the technology under U.S. leadership, make sure that it's all disconnected from ByteDance going forward, and that it is very robust and secure.
Former U.S. Treasury Secretary Steven Mnuchin speaking to Wall Street Week anchor David Weston. Well, still ahead, a deep dive into India's economy with the Indira Gandhi Institute of Development Research. We'll discuss the main risks to growth and markets later this hour. But first, hear why PineBridge Investments believes Japan has no formal policy to support the yen, which may not be a bad thing. More on their market outlook coming up. This is Bloomberg. Welcome back. Minneapolis Fed President Neil Kashkari thinks it's likely the U.S. Central Bank will hold rates until officials are confident inflation is under control. Speaking with Bloomberg TV at the Milken Institute Global Conference, Kashkari said the Fed will do what's needed to hit its 2% target.
The second half of 2023 surprised us at how rapidly inflation fell. That was really good news, and the economy remained strong. We all hoped that was going to continue. The first quarter of this year, it seems like it stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time. I think we're in a good place right now. Labor market is still strong. We can take our time to get more data to see if disinflation is going to continue. And if it does, great. If it doesn't, then we need to take that on board.
What is the complexion right now of disinflation? What actually drove us, at least down to the level where we're at right now?
Most of the gains that we saw last year were supply side improvements. Supply chains getting better, Americans coming back to work, a lot more workers entering the labor force. That's really positive. I don't think monetary policy actually brought demand down that much. And so most of the gains were because of the supply side. Now the question is, if monetary policy has to take us the rest of the way there, is it tight enough to do that? I wrote an essay today on our website raising that question. And I'm not sure how tight monetary policy is. We need more data to assess it.
How do we know that the disinflationary process has still some ways to go? Or how do we know that maybe this is it? This is the new normal?
Well, it's not the new normal because it's 3%, and the Fed can and will achieve 2%. The question is, if disinflation is still underway, then maybe it'll continue on its own, and we can then take that on board. If we need to hold rates where they are for an extended period of time to tap the brakes on the economy, or if we even needed to raise, we would do what we need to do to get inflation back down.
I have to just ask you, though, about 2%. And I know why the Fed stands by that 2%. But I talked to people around the room this week here, and their cost of capital, they're basing that more on closer to a 3% rate. And the idea is they're saying, look, the 2% target, that needs to come up. That's not the reality long-term structurally, at least not for the folks in this room.
Yeah, I disagree with that. Yeah. I mean, I think that ultimately the central bank, whether it's the Fed or the ECB or the Bank of England, can determine whatever the inflation rate is. And over time, if they conduct their policy appropriately, people will come to understand that, will adjust their behavior. We're committed to 2%. We will get to 2%, and we will get an interest rate environment necessary in order to achieve 2%.
Minneapolis Fed President Neil Kashkari speaking with our colleagues Carol Massa and Romaine Bostic. Well, joining us now here in Singapore is Omar Slim, PineBridge Investments co-head of Asia Fixed Income. Omar, good to have you with us. Are we, or is the market too optimistic or too pessimistic about rate cuts right now?
I think the market was a bit too optimistic in terms of, one, the number of cuts, particularly in the beginning of the year, and the timing of the cuts. My sense that now the market is a bit more balanced. The Fed really, the economic data first brought us here, and I think the Fed, particularly the press conference of Chair Powell, was very, very interesting, in the sense that it narrowed the probability or the range of outcomes from the Fed. Essentially, they're saying they're not going to hike unless there's really significant upside surprises on the inflation, and they're going to be waiting. And I think that's what the market is kind of positioned in right now. So the short answer to your question, I think the market is probably more balanced now than where we were at the beginning of the year.
So what do you do with your fixed income portfolio? Are you doing anything differently?
I think duration is interesting to play the range. We thought that the market was getting ahead of itself in the beginning of the year, particularly in terms of the timing of the cuts, the number of the cuts. So we adopted a position that was a bit more defensive when it comes to duration. And I think that worked quite well, particularly in the past month and a half or so. I think now the rates will probably gravitate towards a lower yield. But I think it's a conducive environment for range trading. I think generally within the fixed income market, we like some of the short end and we like some of the long end, so it's a bit of a barbell approach. And I think that has been a good strategy actually for the past year or so.
You talk about playing duration, but duration makes sense if the assumption is the Fed will cut. We know markets have been wrong for a very long time now. So how do you hedge against that? How do you play that?
It's a great question. Actually, the market generally has been wrong. And the Fed has generally been also wrong when you look at the dot plot and the projections and so on. And I think that's what creates the opportunity to trade duration. One of the reasons why, I said it on your show actually before, that I thought that the cuts would probably be later than the market expected. I said it early last year. And the cuts will be less than expected, is that the Fed is still trying to make sure that they don't make a policy mistake like the transitory inflation narrative, which proved to be wrong. So I think this creates opportunities in terms of trading duration, and I think now we're in a conducive environment for range trading.
Credit market spreads are so tight. Why bother?
Look, I think frankly that's a good question in the sense that there are some vulnerabilities when it comes to spreads, and that's both for investment grade market as well as high yield market. If you look at certain markets, particularly developed markets, high yield for instance, half of the market is trading in ranges that are typical of investment grade markets, less than 200 basis points to the treasuries. So yes, I think the spreads are vulnerable, and I wouldn't discount a bit of a backup in terms of spreads. Having said that, I do think that generally investment grade markets will be resilient because of the overall yield levels and because of corporate fundamentals.
When it comes to fixed income, is the right way, is the right strategy still to chase yields?
No, I think it hasn't been the right strategy for a very long time. So the short and definitive answer is no, do not go after carry or after yields. I think you need to essentially have a very important driver, which is have a view in terms of duration, particularly when it comes to the investment grade market. In terms of the high yield market, including in Asia, where we do see some opportunity, it's much more idiosyncratic. But the short answer to your question is no.
I think market has been taken by surprise by the persistent USD strength, and that is posing a lot of risks. When it comes to perhaps a possible new default cycle, how are you assessing that? What are you seeing in the market?
I think that's a very good question, particularly when it comes to some of the local currency bond markets, and frankly for some of the G2, G3 currencies. We can talk about the yen if you like as well. I think the way to answer that question is in two ways. The first one is we think that generally the regional central banks will just wait and see the Fed move first. As such, they are price takers, and that creates vulnerabilities in terms of the local currencies, and it's leading to some defensive hikes like what we saw in Indonesia, for instance, recently. In terms of defaults per se, I think when we shocked some of the corporate issuers that we follow, for instance, on the credit market, we saw that the vulnerability is there, but it's there for a specific segment where there's a bit of a mismatch between the revenues and liabilities and so on and so forth. And I think that has been a trend over the past few years because of the increase and the growth in terms of the local currency bond market. So yes, there are vulnerabilities, and it might lead to some hiccups, perhaps not defaults as much as one would expect. But I think the growth of local currency bond markets mitigated that weakness.
India, it's been front and center. How are you assessing how attractive Indian bonds are, bearing in mind of that bond inclusion? Or has that story been played out already?
I think it has, to a large extent, been played out. I think India is a very good story. The good news is that it's a good story, and also what needs to be factored in is that it is also in the price already, because India has been a kind of a darling of the market for quite some time, and that's really Firstly, I focus on the fixed income markets, but whether you're talking about the equity side or the fixed income market side, whether you're talking about the local currency side or the dollar side, India has been a beloved kind of country by the markets. I think that's to a certain extent priced in. So we're a bit wary of valuation when it comes to the bond market there.
And final question before we let you go, we have to talk about the yen.
Of course.
There are murmurings out there that perhaps we could see a rate hike, perhaps Ueda under pressure from the government to do something to address the weak yen.
I think what's happening in Japan is fascinating, and it's a very interesting story. We spoke about that quite a few times in your show. I think what's really interesting at this point is to realize that I think the Japanese policy markets have been very half-hearted about supporting the yen. And that's one because they really can't accept if they do a very aggressive hiking cycle, which I think is very, very, very unlikely. They might hike, but I think it's very highly unlikely that they hike aggressively. And two, and which is an important question, is the weak yen is actually not that detrimental to Japan. And I think they have this kind of policy of kind of really letting it go while saying something else, particularly by the Ministry of Finance. I think that's slightly incoherent. But my view is that the yen will continue to be weak, and then interventions will only be somewhat effective in making sure the market is orderly, but not propping up the yen. So
the weak yen beneficial to Japan, but less beneficial to its exporters now than before, especially the automakers. Omar, thank you. Omar Slim, PineBridge Investments co-head of Asia Fixed Income. And we have breaking news right here. It is from a Bloomberg scoop. JP Morgan paring down its exposure to Giganti after insider allegations. JP Morgan limiting its dealings with Summon settlers Giganti Capital Management, which is a hedge fund, giant hedge fund charged with insider trading by authorities in Hong Kong. And that's according to people familiar with the matter. Plenty more ahead. Keep it here with us. This is Bloomberg. Well, we're keeping an eye on Apple suppliers in Asia today. That's after the tech giant unveiled a new AI-focused iPad Pro and a larger iPad Air. The Pro revamp also includes an OLED screen and faster M4 chip. Apple aiming to reinvigorate a tablet lineup that has languished over the past 2 years. Now, the company's shares were little change in New York after that announcement, and those suppliers pretty mixed. Sunny Optical down 0.7%. AAC, though, surging about 5% right now. Well, also keeping an eye on Hyundai Marine on the back of that IPO. What a debut, jumping as much as 45%, now up almost 50% in its debut in Korea after an IPO that was 200 times oversubscribed. It is the largest IPO in Korea since 2022, and it makes Korea Asia's second largest IPO market of 2024. KKR, by the way, remains one of the bigger holders, a 24% stake in the firm, even after the listing. Take a look where we are in terms of Chinese self-driving tech stocks. They are surging at this point in time on the back of news from Tesla. Plenty more ahead. This is Bloomberg. Live shot out of Shanghai. Welcome back. China markets just heading to lunch, and the CSI 300 index down 0.7%. Chinese markets taking a breather after the MSCI China index jumped 24% from January lows. Morgan Stanley saying that if you're chasing that rally, well, chase the themes, not the indexes. There may also be near-term technical overbought signals which could deter further buying by global quant funds. CSI down, Shanghai Com down in terms of the yuan, 722.46, weaker versus the USD by about 0.1%. That's China. Let's get to Japan, which is coming back from lunch break, and Avril Hung is on top of that, Avril.
Yeah, Has, we're just about returning from the lunch break for stock markets in Japan today, where we've been seeing the bleed in the region. That market is leading the declines in the Asia Pacific, and it's being dragged by some of these tech names after their US counterparts struggled for gains overnight. The focus now shifting to earnings, and we have the likes of Toyota reporting today, but also remember later in the week, Nissan, Honda. I'll talk more about that in a bit, but among the things that we're watching out of Japan is that view of how Ueda-Kishida meeting could be adding to expectations that the BOJ will make a move in June. This could include reducing bond purchases, and this is the view of SMBC Nikko. We also keeping an eye on a 10-year auction today. It's unlikely to go smoothly. So among the headwinds for Japanese bonds, although we're seeing some gains on the 10-year now, dollar-yen moving past 155. Okay, flip the board. Let's take a look at the yen's impact, the weakness of the yen, and how that has played out for automakers. As our newsroom colleagues have been pointing out, typically this is a good thing because it helps to inflate the overseas value of their profits, their sales. It helps to price their exports more competitively. But as they highlight, we've seen that relationship broken down this quarter. As the yen weakens about 2%, we've seen the automaker index slide about 4%. So that's going to be key to watch as those earnings are revealed. But something else we're keeping an eye on, also flip the board, is the MSCI China. You spoke about how it's been seeing that surge since its January lows. The reasons for this include the rotation out of Japan, but also how things have just gotten so cheap. The other final piece potentially of the puzzle when it comes to the run-up in the MSCI China will be key to watch will be the Tech 8 earnings, as they have that outsized impact on these Chinese benchmarks, Has.
What a run it's been. Avril Hong, thank you. Let's dig deeper. Let's bring in our MLive executive editor, Mark Cutmore. Mark, I mean, we talk about, Tech 8, move over Max 7. Here comes Tech 8. You got to wonder whether that rally is really sustainable.
So, first of all, I love the idea of something to finally shift Mag 7, which has been like impossible to be a strategist around, because I think it's distorted the indexes in the US so much, and therefore distorted the analysis. And some people like myself were kind of slow to realize that, wait a sec, when you're talking about US equity indexes, you need to really just be talking about Magnificent 7, not the broader index like we used to. I think this piece, this is based on a piece from BI, Marvin's Chen. It's an excellent piece, and it's talking about the fact that, hey, Chinese stocks do have their own tech component to kind of compete with the Magnificent 7. And that because they're discounted by 30 to 40%, in fact, this might provide momentum to the rally. Now, from an entirely different angle, my team generally believes that the overall bull market in China and Hong Kong stocks is sustainable. It's a bit worrying to suddenly get excited right now after the last few months of extraordinary gains, and I don't think short-term we're particularly excited. But is it over the next year sustainable? Yes. Will it likely outperform the US? I think so, yes.
Well, how much more upside, right? Because we've seen that rally, and yet when you take a look at the likes of Meituan, Baba, Tencent, they're still looking really cheap. I mean...
Yeah, they are. I mean, that's why I think the potential upside here is massive, but I'm going to add a qualifier at the end. So first of all, as you say, really, really cheap. And I think, you've had not only really, really cheap, but the whole world is massively underinvested to the China story. You're getting signs the Chinese economy is turning around. You've seen growth forecasts, the Chinese economy, being upgraded by only by 0.3 percentage point over the last couple of months. But still, they're being upgraded up to above 4.8% for this year. Growth for next year is being upgraded. So we're seeing a little bit of a turn in the narrative of the Chinese economy. There's signs that the housing market collapse. It's not going to suddenly bounce, but we've gone through the collapse bit. Now we're at kind of the long bottoming process. And you're getting the government turning more supportive on fiscal side, monetary side, and structural reform. So there's a load of narratives that are turning at once. And with the discount, I think this is like potentially just massive upside over the next couple of years. Like, I think you're talking about double-digit gains year after year as potential. The big qualifier is, look, the problem with Chinese stocks for the last few years has been the leadership and the sudden whims and change of policy from the very top. Xi Jinping and his policymakers are still in charge, and that risk will not go away. There's a chance we could go up 30, 40%, and suddenly they clamp down the private market and collapse things again. So I think there's massive potential upside, but the risk is not going away.
Lots of upside, like you said, including the increasing buybacks that we've seen since 2021, that's supporting shareholder returns. I mean, The question really is, if you want to get in, when do you get in? Considering the risk that you just mentioned to us.
I think it's one of these classic stories. I mean, like any person would, wealth manager would tell you, it's not. It's probably a harder one to pick exact timing. And if you are a short-term trader, you've missed the accelerated rally. Wait for some pullbacks. There'll be some pullbacks along the way. I think this is maybe this exact moment's less exciting, just when everyone else was getting excited. I think if you didn't buy a few months ago, wait a little bit now. But I think it's one of those classic things where, as the wealth managers say, this is probably a story you've got to increase exposure to slowly, gradually over time, rather than trying to time it perfectly, because you are going to get that volatility from these random headlines. But it is a sustainable story.
I want to pivot to the yen, just because we've been talking about the yen, well, all month long. And I'm just wondering, are you seeing a pivot from Ueda now, saying that perhaps it is time to have a rate hike?
It's certainly interesting. His comments seem to have a different tone this morning. People seem to be kind of dismissing it a little bit and not saying much. I think ultimately, as you know, I'm a long-term yen bear, and I don't think that's changed. I don't think intervention changed anything.
And you say fundamentals are not supporting
Absolutely.
the
Fundamentals are bearish the yen still. As I said, it's not about dollar yen, it's about the cross yen continue to go higher.
But the question is whether Ueda is likely.
But I think that yen depreciation will force the BOJ more likely to hike this year. I still think the BOJ, even though they were dovish recently and implied no rate hikes comes in, I think they're still likely to hike another couple of times this year. And I think that's something that might be a story that will probably play in the third quarter. And that's why the yen story is going to get harder. Even though I'm still bearish the yen, I think it's going to be more volatile from here. It's less exciting, and I definitely don't think dollar yen's is easy.
All right. Mark Cutmore, MLife Executive Editor, thank you so much for your thoughts today. Well, still ahead, the Indira Gandhi Institute of Development Research says India has pulled off an impressive recovery post-pandemic. We'll discuss the main risks facing the economy. Keep it here with us. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching India Focus, and we're counting down to the India Open in about 6 minutes, and futures pointing to a lower open, pretty much in line with the rest of the region. Now, here's a look at the India VIX index, showing a surge in volatility over the past 9 days after a period of relative calm. For more, let's bring in our equities reporter, CJ Chakravorty in Mumbai. CJ, what's stoking these market fears?
Well, at this point of time, it seems like there is some bit of recalibration happening of expectation with respect to the ongoing general elections. The market went into these general elections when voting started back in April, with expectation that BJP-led coalition of parties will win a handsome majority. I mean, the coalition itself has touted that they want to win 400 seats. The market was, pricing in that expectation. But clearly, after the first couple of phase of votings that have happened, it seems like there is some tampering on those expectations. And as we inch closer, to the election day, counting day, which is on June 4th, market, it seems, is showing some appetite to buy some insurance on the downside. Let's not forget, valuations are quite expensive for Indian stocks. The benchmark indices here, the Sensex and the Nifty, are sitting quite close to their record highs. So therefore, the downside seems quite more larger than the upside from any positive news. So therefore, we are seeing the volatility therefore going higher. Option pricing is also, if you look at the implied volatility for options expiring in June, late in June, pricing implied volatility there is also inching higher. So there's just a bit more concern now that the market is reflecting than what was the case about a month ago.
CJ, you talked about how market expectations about election are changing, yet we haven't seen a significant sell-off. Why is that?
Yeah. I think one factor to look at it, that could explain that is that earnings so far have been doing quite okay. If you look at the 28 companies that had reported earnings as of Monday, almost a little more than 50% of them were surpassing analyst expectations. And if you look at 2024 overall, MSCI, the future EPS or 12-month forward EPS for MSCI India has been seeing upgrades and has been surpassing upgrades that we are seeing in other markets in Asia, particularly in China, Korea, as well as Taiwan. So while the politics of it all becomes a little less certain in terms of the outcome, the earnings, which are always the major driver of markets in the long term, that continues to provide solace to investors, and that is why maybe the price is not reflecting the jitteriness that we are seeing in the fear gauge at this moment.
CJ Chakraborty in Mumbai, our equities reporter, thank you so much for that. Of course, India is into its final round of election. Rajeshwari Sengupta is Associate Professor of Economics at the Indira Gandhi Institute of Development Research. Rajeshwari, thanks so much for joining us. What are your thoughts on how the elections are going right now and the impact it may have on the economy?
Well, I don't particularly want to comment on the elections. I think they are sort of going as expected. As the previous commentator said, that there could be a little bit of jitteriness about the margin with which the ruling party might win. But I don't think there is a whole lot of doubt about the probability of their winning the elections. And of course, we'll get to know soon about it. In terms of the consequences or the implications of it, I think, of course, from an economic stability standpoint, it's not a bad idea to have the same party continue, the same government continue, particularly in terms of continuity of policies and reforms. So I think that would be a net positive, and that is what the market is also looking forward to. And going by their manifesto, they do have some promising points. For example, continuing on the path of fiscal prudence, which is extremely important for macro stability. Because we do have a high fiscal deficit of close to 6% currently, and the government plans to bring it down to less than 4.5% by 25-26.
Right.
It seems that they are going to continue on that path of fiscal prudence, simplifying legislations, promoting exports. So I think there's some of the policies that we can look forward to post-elections, and it would be good to see how it all turns out.
In terms of policies that can be expected, what would you like to see in terms of priorities? What are the low-hanging reforms that the next Modi government can implement?
Well, there are two different parts to it. What is it that what I would like to see as an economist? And the second is, what do you expect the government to be implementing? I think in terms of what economists would like to see would be structural reforms, because while we have an impressive growth performance and resilient recovery from the pandemic, it is also true that we need to be able to sustain the 7-8% of growth rate for a long period of time if you want to achieve a developed economic status, which is what the government wants to achieve clearly. But for that, we need structural reforms. We need factor market reforms, land reforms, labor market reforms, financial sector reforms. All of these things have been pending for a very long time. And unless we implement these reforms, we'll not see the kind of productivity boost that is needed to be able to sustain a high growth for a long period of time. So that is what I think as an economist, I would like to see on the table. And also boosting exports significantly, because it's a historic opportunity for India, I believe, that with a lot of companies trying to look at other alternatives from China, India could offer very well that alternative. But for that, we need to be able to implement more stable and predictable policies in order to be able to encourage those companies to come and set up shop in India so that we can benefit from the China Plus One strategy. So that is also something that I would like to see. But in terms of what the government might be looking at in terms of low-hanging reforms, as I said, simplification of economic and commercial laws is probably something that they would look at, because that would definitely improve the ease of doing business in the country. Also, maybe entering into more bilateral free trade agreements with other trading partners. That might also help exports to some extent. And as I said, remaining on the path of fiscal consolidation is again something that probably they would look at. I'm not so sure about how much they would prioritize structural reforms, because we haven't heard a whole lot of sound about that. So that's sort of the missing gap, I would say.
Rajeshwari, we know that there's been weakness in the rural sector. I'm wondering if the abundant monsoon season, which is expected, will help turn things around.
Yes, the agricultural sector definitely has not been performing very well. And that is a big problem for us, not only because the rural sector is a big source of demand, but also because it feeds into food inflation, which has been a persistent problem over the last 2 years or so. So there is the forecast of monsoon being stable and good for this year, and that might definitely help the rural sector. But in general, I think the rural sector has been affected by a lot of shock starting from demonetization and the informal part of the rural sector with GST and, of course, the pandemic. So to some extent, the abundant monsoon forecast might definitely help, but we'll also need agricultural reforms, as I said, in order to boost productivity, a lot of minimum support price related discussion that have been happening. So all of those things would have to be put in place over and above the abundant monsoon. Hopefully we get blessed with that. So a combination of multiple factors is what is needed to get the rural sector back to where it was before the pandemic.
This is an economy that's still facing inflation risks, perhaps from food as well as oil. Might that prompt the RBI to delay rate moves, also given where the Fed is right now, pretty much undecided what the next move might be?
Yes, I think while inflation has come down within the RBI's inflation targeting band of 2 to 6%, and core inflation has in fact collapsed to 3%, still there are risks to inflation from food prices and potentially oil price increase from the escalated tensions in the Middle East. So to that extent, RBI might hold the repo rate at 6.5% for a while, because unless they see the inflation moving to the target of 4% in a sustainable manner, they probably will not start cutting rates. But yes, it is also true that till the time the US Fed starts cutting rates, we probably won't see RBI lowering the repo rate either, because there are the obvious repercussions of a steep depreciation of the Indian rupee, which the Indian central bank might want to avoid. So maybe it'll be a combination of both, that they are waiting to see whether headline inflation will start moving in a sustainable way towards the 4% target. And also, if you're lucky enough, the timing of that coincides with the Fed cutting rates as well, because I think it's very unlikely that RBI will cut rates before the Fed does, given the exchange rate repercussions of it. So,
Right.
so I think that's basically what would guide RBI's policymaking going forward.
Probably waiting on the Fed. Rajeshwari Sengupta, Associate Professor of Economics at the Indira Gandhi Institute of Development Research. We thank you so much for joining us today. Well, India's been trading for about 2 minutes now. Let's do a check on how our markets are doing there. Of course, Asia under pressure. So is India right now. Sensex index down 0.4%, losses too for the rest of the benchmarks. The rupee at 83.4962. We've been talking about how the calm in the Indian market is getting shattered by speculation Modi's party may win fewer seats than expected in the ongoing national elections. Well, still to come, we discuss a new report on the world's wealthiest cities. Find out why Hong Kong has seen a decline in its millionaire population. Well, what's the story for Singapore? That is next. This is Bloomberg. Welcome back. Hong Kong and Singapore have been hailed as among the wealthiest cities in the world by Hanley and Partners, but the immigration consultancy firm also notes a decline in Hong Kong's millionaire ranks as wealthy expats leave for Singapore. For more on this, let's bring in our wealth reporter, Claire Ballantyne in Hong Kong. Claire, Hong Kong's loss, Singapore's gain.
Yes, we've seen some millionaires move away from Hong Kong and into Singapore. So that's affected the rankings in this latest wealth survey. So that's kind of been the trend. In the past 10 years, Hong Kong number of millionaires has decreased 4%, while at the same time, we've seen Singapore's number of millionaires really increase. So it sort of speaks to this trend and this rivalry between the two cities and seeing how people are departing Hong Kong.
And how can Singapore sustain its position, you think?
We'll have to see. A lot of the wealth gains over the past 10 years in this ranking have been driven by global equity market gains. We've seen, financial markets around the world really increase in the past decade. But again, you have sort of these geopolitical issues and these other reasons that people move and change locations. So right now, we're still seeing New York as the city with the most millionaires. 1 in 24 people in that city are millionaires, which is pretty striking. But we're also seeing increases in Singapore. Tokyo is still doing really well in terms of millionaires, and so is the Bay Area. So we'll sort of have to see, where people want to move and what becomes more attractive in terms of location. But at least for right now, we're seeing Hong Kong on the decline and Singapore rising.
Claire, how about China? Because we know the economy has been under a lot of pressure.
Yeah, so in terms of China, cities on the rise actually include China's Shenzhen. The number of millionaires there has surged over 140% in the past decade. Now, this report, at least what I have in front of me, hasn't really delved too deeply into the different cities in China, but in terms of Shenzhen, really on the increase.
Claire, thank you so much for that. Our wealth reporter, Claire Ballantyne in Hong Kong. We know that for London, for instance, has lost about 10% of its millionaires over the past decade. Well, here are some top geopolitical stories we are following. Donald Trump's criminal trial for allegedly mishandling classified documents has been postponed indefinitely. It is a significant victory for the presumptive Republican presidential nominee, who's facing 4 criminal charges and seeking to avoid multiple trials before the November election. Trump is currently in court on charges he concealed hush money payments to a porn star. Chinese officials are threatening to release audio of a purported phone call with a Philippine military official that Beijing claims is evidence of an agreement over disputed territory in the South China Sea. According to a transcript seen by Bloomberg, the head of the Philippine military's Western Command agrees to a new model in handling resupply missions in the area. Manila has previously denied such deals. The U.S. says Israel and Hamas should be able to resolve their differences over the proposed ceasefire in Gaza. That contradicts top Israeli officials who say the two sides remain far apart. Truce talks have stalled as Israeli forces edge closer to the city of Rafah. Meanwhile, President Biden has used a speech remembering Holocaust victims to condemn anti-Semitism.
That hatred was brought to life on October 7th in 2023. On the sacred Jewish holiday, the terrorist group Hamas unleashed the deadliest day of the Jewish people. I have not forgotten, nor have you.
Well, in the markets, we're tracking some move as Nintendo in particular currently down by more than 5%. Shares of Nintendo tumbling the most in over a month after the company warned of a sharp profit fall. It also signaled a next-generation Switch wouldn't arrive till 2025. The outlook, of course, falling shy of expectations, even with weak yen boost. Toyota currently down more than 1%. Mitsubishi Heavy Industries, Crafton in the opposite direction. These are some of the companies that will be reporting earnings later on. Nintendo, though, in the opposite direction, down by more than 5%. We're also tracking the likes of Xiaomi and other Apple suppliers. That's on the back of BI suggesting that Lenovo, Xiaomi may lift sales as Huawei chip curbs hardening. Take a look where we are in terms of displays. Xiaomi currently up by more than 6%. Lenovo in the opposite direction, down by 0.5%. In the wider market, of course, Asia looking for a catalyst to go higher, but finding none today. The Fed is front and center. Trade is pretty much divided on what the Fed will do with rates this year. Take a look where we are in terms of the yen. There is one currency that is under some pressure. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.